There's a rule Maya has always followed without ever saying it out loud. Investing is for other people. People with suits. People with spare money. People who already speak the language. Maya works at a daycare, pays her rent on time, and keeps a careful little cushion in savings. She's more careful with money than most people she knows. But somewhere along the way, she picked up a belief that quietly shapes what she does with every paycheck. The belief that the investing world has a velvet rope stretched in front of it, and her name is not on the list. Today, we're going to walk up to that rope and look at it closely. Because here's the short version. It used to be real. It isn't anymore. This is the myth that investing is only for the rich. By the end of this video, you'll know where the myth came from, what changed, and, honestly, what still stand in the way. All of it in plain language at a calm pace. First, let's define the word because the myth lives in the fog around it. Investing means using money you don't need right now to buy something that can grow in value or pay you over time. The most common version is buying shares, small slices of ownership in real companies. Own a slice, and you own a slice of what that company earns. That's it. There's no secret handshake. Buying one small slice is the same act as buying 1,000 slices. The only difference is the amount. One quick distinction, because these two words often get blurred. Saving means setting money aside somewhere safe and steady, for emergencies and for plans you'll reach soon. Investing means putting money to work for years, accepting ups and downs along the way in exchange for the chance to grow. You need both. They simply do different jobs. And here's why this myth is worth busting rather than shrugging at time. The most powerful ingredient in investing isn't a big salary, it's years. When someone believes the door is closed, they wait. And waiting quietly costs more than almost any fee ever will. So where did the velvet rope come from? It wasn't imagined. For most of the last century, investing really was gate-kept. If you wanted to buy shares, you usually went through a broker, a licensed middleman who placed a trade for you. And brokers charged commissions, fixed fees that took a painful bite out of any small order. Paying the equivalent of $50 in fees just to invest $100 made no sense at all. So people with small amounts simply stayed outside. Many funds set high minimums too, sometimes thousands of dollars just to open the door. And the whole world was wrapped in jargon. Bull markets, bear markets, price to earnings, a language you practically had to pay someone to translate. So your grandparents' picture of investing, a wealthy man on the phone with his broker, was accurate for its time. The myth isn't a lie about the past. It's a memory that outlived the facts. Information was scarce back then, too. Prices lived in tiny newspaper tables, and research lived behind office desks. Today, that same information is a free tap away, which quietly changes who gets to feel confident. Because over the past few decades, 3 doors swung open, one after another. Door 1, low-cost index funds. An index fund is a single investment that holds tiny pieces of hundreds of companies at once, and simply follows the whole market instead of paying experts to guess at winners. Owning a little of everything became cheap and simple. Door 2, fractional shares. If one share of a company costs $400, you can now buy a tenth of it for $40 or $100 for $4. The price of one share stopped being the price of entry. Door 3, technology. Many investing apps and brokers today charge no commission on basic trades and ask for no minimum at all. And in many workplaces, retirement plans let you invest a small slice of each paycheck automatically, sometimes with an employer adding a little extra on top. The rope came down, quietly over years, which may be exactly why so many people never heard it fall. Let's make this concrete with easy, round numbers, the kind you could check on the back of an envelope. Say Maya invests $100 a month into a broad, low-cost index fund. $100 a month is $1,200 a year. Keep that up for 30 years, and she has put in $36,000 of her own money. Historically, broad stock markets have averaged growth of around 7% a year over long stretches. Never smoothly and never guaranteed. But if her money grew at about that pace, her $36,000 could become roughly $120,000. Let that settle for a moment. She put in 36. Compounding The way growth itself starts earning its own growth to the rest. Small amounts, given time, are not small. And notice what that example did not require. A windfall, a genius stock pick, or perfect timing. Just an ordinary amount, repeated steadily, and left alone. Now, for the part many videos skip because it matters here. The rope is gone, but the room still has real rules, and pretending otherwise would be its own kind of lie. Rule 1. Build a small cushion first. Investing works best with money you won't need soon. So most people set aside a modest emergency fund before they invest anything. That cushion is what keeps a surprise car repair from forcing you to sell at the worst possible moment. Rule 2. Risk is real. Markets fall, sometimes sharply, sometimes for years at a stretch, and nobody can promise you that 7%. Investing is a long game, measured in decades, not weeks. Rule 3. It is not a shortcut. Anyone promising to double your money quickly is selling something. And Rule 4. Costs still matter. Small fees, repeated for decades, quietly shrink a pile, which is exactly why low-cost funds change the game. And Rule 5. Honestly, income still matters. Earning more makes investing easier because more is left over after essentials. The myth was never that wealth has no advantages. The myth is that everyone else is locked out. And that part simply isn't true anymore. So Maya starts where she is. She keeps her small emergency fund, then sets up $25 a month. Not because it will make her rich this year, but because it makes her an owner. And because starting teaches you more than waiting ever will. And the velvet rope she had been obeying all those years, when she finally walked up close, there was no rope. Just a sign in her own mind, placed there long ago by a world that no longer exists. If your money story includes a sign like that, you're allowed to question it. Start small, start slow, start informed. The door has been open for a while now. So here's what we'd love to know, down in the comments. What money belief did you grow up with that you started to question?